Thank you, Tom. So I'm going to change pace here, change gears here, and talk about innovation. We are in a university, and in particular right now, because there's a bit of a gloom and doom with the oil prices being down, and many layoffs coming, mostly in the service industry. Schlumberger just announced another 11,000 yesterday morning. And so what can we expect in terms of innovation? And I'm here to tell you that you can expect a lot of positive things, and I'm going to show it to you why that is. And actually, you've just heard from Jim. See, these guys at Southwestern, I mean, they're a bit unusual, so don't take it home that everybody behaves like that. But, I mean, they've been making money in an extraordinarily low-price environment. In Fayetteville, gas is dry as a bone. You get Henry Hub pricing for it, and they've been making money just because they're innovating. I mean, you saw his slides. You saw when how their finding and development costs have plummeted, etc. Not all the companies are that way. So they have continued to innovate in what was a really poor market. So people like that will always innovate. But what about the rest? Here's what we'll talk about. Here's what's been going on. The price of, I'm sorry, I had to apologize, Sonny and Cher. I'm old, okay. So what we had is 50% drop. But what's curious is that been bouncing up 25% from that 45 number, okay? And it's been mostly supply driven this last little bit. And here's my prediction. My prediction is that this sucker here is going to sawtooth up and down, up and down. I'm going to prove it to you, okay? And I mean, I mentioned that to Pam during lunch. She said, well, that's going to be terrible for communities and for industry to be responsive to that. And I said, yeah, but I can't do anything about it. That is going to happen. And I'm going to show you why. Here's what happened in the past, and we won't dwell on it, but basically for 2 years, from 2012 to 2014, in that period, the US went up by about 2 million barrels per day, and the rest of the world dropped by about 2 million barrels per day. So it was in balance. So nothing bad happened. Price of oil stayed, okay? And then here's what happened. OPEC chose not to stabilize prices. US shale oil unwillingly became the swing producer. A swing producer is a producer that if he sneezes, the world catches influenza. Okay, that's a swing. That's a swing producer, and the U.S. has unwittingly become the swing producer, and I'll get into that a little bit more. China's growth has plummeted. They used to be in double digits. They're down to 6.8, which for them is pathetic. This is GDP growth. This is what their forecast for this year. Modi is making it strides in India, but it's not quite there yet, and Brazil is in trouble and in deep yogurt. So supply threats continue. Libya's added 700,000 barrels a day last year, in the end of last year, and now they were down to 200,000 a couple of weeks ago because of violence and ISIS and so forth, and so up and down. US shale output has not quite dropped yet. It's kind of sort of heading down and has not dropped yet. Rig count has dropped. Several speakers have spoken to that. Rig count almost doesn't mean much right now. And they've spoken to it, and mostly because rig efficiencies have gone up. The well count has not dropped. The rig count has dropped. Be careful with that, okay? But the rig efficiencies have gone up, and Jim showed that others did too. And of course, you know, right now there's a shale buying opportunity. Okay, but that nobody here cares about. So here's an interesting point. Some other speaker referred to it, and that is oil price is not oil price. Okay, it used to be. Okay, back here in 2011 and before, lockstep. Brent, WTI were in lockstep. And because they're basically the same fluid, the same quality oil. They should be the same price. And then after 2011, it spread. Okay, what happened? Well, 2011 is when we started producing from Bakken, when we started major production from the Eagle Ford and Bakken. And we were not able to move it out. Okay, that's part of it. And we're not allowed to export. So not being allowed to export is the primary reason for the spread. Somebody else mentioned that. That's the primary reason for the spread. You allow export, this sucker will go right back into lockstep. Now, there is a little bit of another nuance. Eagle Ford will, Bakken is still, doesn't have the pipeline infrastructure, still it's moving by rail. Keystone XL is, is goodness knows what will happen with it. By the way, Keystone XL not only about Canadian oil, about half of it is about Bakken oil coming down here. So, by the way, one of the things I tell students is if you say no to something, if you're tacitly saying yes to something else, figure out what you're tacitly saying yes to. And if you still believe in that, cool. If you don't believe in that, re-examine your no position. And in this case, saying no to Keystone XL is tacitly saying yes to unregulated oil on trains. And I use the term unregulated because let's say sparsely regulated. Okay, all right. So this is the story with pricing. And up till now, I talked about oil. I got slightly chastised for this by one of your faculty members who tends to be a little outspoken about that this is not about oil, this is about gas. And so I have actually modified some of my later part of my presentation because sustaining her ire, I gave it away. I'm not looking anywhere, you see, I'm looking straight up there. Okay, here's what happened to natural gas. It was always low in the US, and then it dropped to under 3. What the heck is going on? I'm here to tell you that there's very little crossover between oil and gas. Okay, 70% of oil is used for transportation. Well, more than 70% used for transportation. And gas is pretty much used for power and petrochemicals. Okay, so why is natural gas dropping down to? And when I last looked, it was about 250. Per million BTU. By the million BTU is the same as about 1,000 cubic feet. I can't explain this to you, but I can tell you why international prices are dropping. Because international prices are pegged to the oil basket. This is an anachronism. It's there. Don't ask. But the price of delivered LNG is tagged to a market basket pricing in the case of Far East Japan oil pricing. Therefore, Asia has dropped as low as $8 on the LNG from $18. So some $18 was mentioned earlier by some other speaker. Well, it ain't 18 anymore. Okay, it's 8 to 9. It delivered to China. Japan might be a little bit more, maybe closer to 10. Europe, which used to run 10 to 11, which was supposedly the price that the Chinese negotiated with Russia, which the general spoke about. I can't believe that number will hold up. But Europe is down to nearly 6. This is LNG, of course, but LNG is the marginal gas in Europe, therefore will drive the price of gas from Russia. So as long as, the previous speaker, I think it was the general who spoke about that we need gas in Europe to combat Russian aggression. No. LNG, gas in the US has caused LNG imports to go to 0. Therefore, our LNG, if you will, which we used to come here, is going there, and that is dropping the price because the supply is higher of LNG. And I told you LNG is the marginal producer, and therefore it is the basis for the price of land gas. So the result is that our shale gas here is causing Russian privation. It was mentioned earlier that 50% Russia's budget comes from oil and gas. And so oil dropping, gas dropping is an absolute disaster for them. So now, what is happening, but though, is the US chemical industry, the cost advantage has now slightly eroded. Okay, it was a time, okay, when oil was 100 and gas was $4 here. And gas was, well, 350, whatever, and gas was 10 in Europe and 18 in Asia. Chemical producers in Europe and Asia were flat, non-competitive, absolutely non-competitive. Of the $120 billion, so some numbers were thrown up earlier of how much new chemical plant capacity is coming in. Of the $120 billion or so of new plant capacity, chemical plant capacity, destined for construction within the next few years, more than half of that is foreign money, which is probably one of the reasons that the dollar is getting stronger. And on it goes. And if the dollar gets stronger, the price of oil drops further, which I'm not going to get into the economics of it. But this is the thing. So the arbitrage opportunity is still there in the sense that U.S. gas is still cheaper than gas in Asia and in Europe, but not that much different. When it's 6 versus 2.5 versus 10 versus 3.5, you see that. Okay. So, but there's still there's a lot of opportunity still on arbitrage because some of the, actually let me go back. Some of the products we can produce, which is not working, you're going back. Okay, did. Okay, is methanol for China. China is the leader in substituting gasoline with methanol. And so methanol produced here is destined for China. Dimethyl ether, urea, and ethylene, I'll get to those in a moment. All of these can be produced in the U.S. at the lowest cost of anywhere in the world. So you have an interesting point here now, where there are certain commodities that even with this low price environment will be produced here. Okay. Let me skip this because in response to what I heard before, I'm going to talk more about gas. So now I'm going to tell you why in the low price environment there will be innovation. The reason is simply you won't survive without it. If you were in a $100 oil environment and now you're in a 50, and you cannot survive with your old cost measures. These people in Southwestern always knew that, and so they continued to innovate. But what is going to happen now is they will innovate now. So you're going to say, that's interesting, good hypothetical point. Does it really happen? And what I'm going to here to show you, and I'm not going to go into details, is that in this decade, and I played in this decade, I was a mid-level manager in this decade. Here's what happened. The rig count dropped from about 2,500 to about 700. Look at that precipitous drop, and it stayed down there. During that time, here's what happened. The cost to produce oil, basically what's called development and lifting cost, take away finding, no exploration. Development and lifting cost dropped from an average of $8 to less than $4. Folks, this is a very conservative industry. And in industries such as this, if you have a halving, I mean, you see in Southwestern numbers, but I'm talking about the whole industry, okay? When you see a halving of development and lifting cost, that is ginormous. And it happened. I'm not going to go into the technology details. That's on the previous slide, which I skipped. So significant technology advances had to be made. They got made. This happened. Okay. So bottom line is this: that downturns are an opportunity for two types of innovation. One is cost reduction, which is the cost to produce the same quantity of oil or gas, and the other is productivity enhancement. And I will tell you the difference of that. While it doesn't seem very different, I will show you an example in a second. But commodity service providers will suffer. So I'm sorry to tell you that the people who will innovate will be the top 4 to 6 companies. Okay, it'll be primarily service companies innovating. Okay, but all companies will innovate too, but they rely on service companies for so much. But what the so-called commodity companies, they're just volume suppliers, will suffer and will either atrophy or get bought up. But I can tell you this: those who do it will profit handsomely. And I'll give you an example. I said Sperry-Sun Performance. That's the company I worked for. From 1988 to 1994, we went from, this is right in the thick of that period when the rig count went to hell and the price of oil also went to hell. We went from being an $87 million sales with an EBITDA, which you don't even talk about, which is profit, very low, single-digit numbers. We went to, in that period, we went to $650 million from $87 million. with an EBITDA, which I'm not allowed to report to you, but in high double-digit numbers, in second quadrant numbers. So over 20%. So here's the point. If you innovate, okay, in that environment, the people who benefit from it will pay value pricing. Because they're getting the value, they'll pay you value pricing. And that is set to happen. So why now? Okay. Oh, let's skip this. Or do you want to hear about where am I on time? I am 15 minutes into it. I'm pretty good on time. Okay. All right. Okay, I'm going to just... He said he wouldn't do it. He said he would tap me on the shoulder.
I missed.
He missed. Here's the real takeaway. U.S. refiners do not want U.S. crude. Okay? Okay. Yeah, they don't want it. Okay. Why don't they want it? We have a very funny situation. We have Canada, next door neighbor Canada, that produces somewhere between 2.5 million to 3 million barrels per day. They don't have a single refinery. It's all refined down here. It's all heavy oil. So it's some kind of relationship, which is sort of interesting, which probably means we won't go to war with each other. And so the refineries have put in a ton of money to refine that kind of oil. They're called crackers and so forth. So all of a sudden, we come along and say, we're producing this light, sweet oil. And oh, by the way, and heavy oil has a discount of about $20, okay, between 15 and $35. I've seen as much as 35. And there's a damn good reason for it. It's got a lot of carbon in it. Okay. So we're saying, why don't you guys be good guys and set aside your cracking capacity and take this light oil. Oh, by the way, 20% more you pay for it, and you're idling your expensive capacity. That's what we're asking refiners to do. And they're kind of saying, nah, we will pay less for you, for your oil. And that's what's happening. So WTI is less than Brent, but Bakken crude is less than WTI. And I've seen as much as $15 less. Okay, $15. And oh, by the way, it's really good stuff. But it's supply and demand. How do you solve that? Let them export it. Because the domestic buyers do not want it, are discounting it, and they have no choice but to accept the discount because there's no export permitted. And for that argument that some people make, that if you export it, the gasoline price will go up, of course it's flawed, but the reason that gasoline price can go up is not because of that. It's because we're allowed to export gasoline, okay? If you're allowed to export something, the chances of prices, domestic prices going up are higher because your supply just went down because you exported it. I mean, it's kind of economics 101, but somehow it doesn't get across. We're exporting 4.5 million barrels per day of refined products, most of it gasoline and diesel. So anyway, enough of this. This is one of those black spot things. Some sunspots or something is going on that the public is deluded into this matter. Okay, all right. Okay, so what are the future hold? I got this one slide and then I got a gas slide. You know why, of course. I already told you that. Okay. So the hurting exporters cannot survive. I'm talking about the Middle East. Okay, not Iran. I'm talking about Russia. They cannot survive. So you expect some bounce back before the end of the year. I'm not into forecasting oil price. Okay, but I will tell you this: if there's a new normal around $50, U.S. production will drop. Okay, and when it drops, when the U.S. production drops, the price will go up. A shale gas well, an oil and gas well, can come on stream. I mean, Southwestern comes on stream in 7 days, whatever he said, okay. Well, more normal people can take 20 days, okay. So, but you decide you can shut in, especially gas, you can shut in and open it up. You want to start a new well? Okay, fine, I'll do it in 20 days. That is the definition of just spigots, okay. You just switch it on and you can switch it off. That is why we will see a sawtooth. Because when the price goes up, they will drill. When the price goes down, they'll shut it in. This is easier with gas than with oil. Okay, notice I got gas in there. Okay, but that is why you will see the sawtooth. So I hope you believe that. One quick thing about Alaska. Alaska depends so severely on oil revenue. They pay a dividend to every citizen, okay? And when that revenue halves, it is going to suffer some privation. Here's a bold prediction. Within 5 years, because we will innovate, okay? Within 5 years, here's what I suggest is going to happen. Some of the break-evens drop below $30. This is oil I'm talking about, okay? If much of the break-even drops below $30, I told you about that sawtooth, they'll all come on stream and all hell breaks loose. We'll be awash in oil. But and it'll probably good for everybody, I don't know, but that's what's very likely to happen. And OPEC will cease to be relevant as a cartel. Cease to be relevant. Because even they're already becoming irrelevant. I told you US has become the swing producer. Okay, here's my gas slide, and I am pretty well on time, wow, okay. And this gas slide is going to show the following. I'm going to put them all up there. Okay, there we go. All right. It's all on dollars per million BTU. I'm sorry, I'm an engineer, okay? So it's all on a normalized scale. That's only way you can compare gas and oil and diesel and ammonia and stuff, okay? Because some is sold in by weight and some by volume. So it's all dollars per million BTU. Right now, gas is about $280 per million BTU. Oil at $53 is around 9. Oil at $80 is around $14 BTU. At $100 is about 17 and a half up here. Okay, what is the point of all this? The point of all of this is that natural gas can make any of these things. Can go to heating and cooling, power generation, but it can go in transport fuels. On transport fuels, by the way, there's an interesting one, and that is this one, dimethyl ether. Volvo has already announced a 13-liter engine that will come out later this year that will run on pure DME. And DME produces 0 particulates. Boom. And the biggest problem with diesel is particulates, PM10 and PM2.5. It's a killer. About 2.5 million people a year die worldwide on that because of that. And so what we have here is you've got we used to make many of these things in oil. So if you start at oil at any of these numbers, and here's what the stuff sells for, look at what that margin is, okay? Not a lot. If you start here, and actually the cost to produce will bring you about here, much better margin. So almost any chemical shown there, if you can make it with oil or gas, you'll be much better off making it with natural gas because you'll have a higher profit margin. So give you an idea on ammonia, which I've shown you, but I'll give you real numbers now, meaning per BTU numbers. Ammonia sells for maybe, this anhydrous ammonia, sells for, from which you make ammonium phosphate, ammonium nitrate, or urea, sells for between $500 and $600 a metric ton. At 280, you should be able to produce for about $130 a metric ton. That, folks, is the definition of profit. Okay, and so my takeaway for South Carolina is the same one I'm giving to North Carolina, where I'm the chairman of the Mining Energy Commission. We've written the rules. March 17th they went in. Maybe we will have gas. Maybe we won't. It doesn't really matter. I'm saying both our states can profit from an industry that utilizes cheap gas from next door. Yeah, the Dominion line is not coming all the way through. I'm happy to tell you it is coming to North Carolina, but for some reason it's not coming right through. This is the one on the eastern side that someone showed. But the Transco line is being reversed, and you're going to get Marcellus gas up to North Carolina for sure. I'm not sure about you guys, but get your governor to agitate and get it down here. You need the gas. But if you get the gas, you can produce any of these. You can produce methanol and ship it to China. You can produce DME and ship it to India, because DME, by the way, blends with, how am I doing? Oh, I'm getting close. Blends with LPG, liquefied petroleum gas, like it doesn't even know it's there. And yet it's much cheaper and it's better for you. And so this is all kinds of stuff. So both our states should seriously consider a chemical industry being advanced, doing these things, particularly because we are port states. I don't know why I'm telling you this, because we're supposed to be competing, but whatever. Okay. But wait a minute, we get offshore oil, Katie barred the door. We are getting that shore support, not you guys. Okay. Anyway, but we can make many of these products very cheaply because everyone knows it's cheaper in the U.S. than anywhere else, and we are a Europe-facing port state, and that is the way we should go. And I think I'm well within my time, within 5 minutes or something, and so we can have questions which are actually legally within the time period.
Sir, you mentioned the industry is very conservative. How did you do that, and why is that?
Why it is that the most conservative company in the oil and gas business is ExxonMobil, and it is also the most profitable. So it seems to help. It's a juggernaut. What brought us here will take us there type of attitude. When I was at Halliburton, when I was CTO, we once did a measurement of who were the best that's bad grammar. Who were most taking up our new technology? And 4 of the top 5 companies in terms of taking up new technology were independents. They were not the majors. And so independents are more entrepreneurial. They'll take it on. But the oil and gas industry as a whole it tends to be conservative. Partly because they're dealing with high capital investments and they don't want to rock the boat. But that's changing. Independents move much faster. Independents meaning the folks who are not vertically integrated, those who don't also have refineries, those who simply produce oil or gas.
Anything else? Thank you again.